got one bar. Don't worry about it. I think I got enough to make it. I got one bar.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is inflation day, and that's right, we get the inflation report out this morning. You know, this is the big question. We're going to see an uptick in inflation. Is it going to go lower? Of course, markets will all be kind of keying off that this morning. Now, yesterday's market, rallied here a bit, and again, we're just kind of still within that consolidation range for the year, but this is going to be one of the big drivers that we've talked about here recently is looking at the CPI report, because that's going to be what keys the Fed. Very interestingly, yesterday I was doing a interview on Fox Business with Charles Payne in the afternoon, and right before me was Naomi Prince, and she's talking about the fact that the Fed is already slated to start ending QT by May. So in other words, starting in May, the Fed will start reducing the runoff on their balance sheet, reducing that rate of quantitative tightening, and it's now expected that the Fed will restart quantitative easing, which is now increasing the balance sheet by the third quarter. So again, this is all very, very interesting given the year that really, there's no sign of a recession right now. Everything seems to be okay. Yes, we've got some weakening economic data, but nothing at this point that suggests that the economy is about to fall off a cliff, yet we've got the Federal Reserve talking about cutting rates and now potentially doing QE by the third quarter. Of course, this is an election year, by the way. But outside of that, you've kind of got to ask yourself the question is why, right? If everything's okay, why do I need to be cutting rates and doing QE? This is going to be the big thing, and Mike and I are going to talk about that this morning on the show. But it is interesting, talking about bonds in particular. In 2022, the 60-40 index, right? So in 2022, bonds had one of their worst returns on record going back to like 1787. And of course, that really weighed on the 60-40 return. And remember, there was just a ton of articles and headline media talk, etc., about how the 60-40 allocation was dead and you should no longer want to have bonds in your portfolio. It's just going to be the end of the world. And then 2023, the 60-40 allocation turned in one of its best returns since the turn of the century. And it actually on a sharp ratio adjusted basis outperformed many other types of allocation strategies and portfolios, kind of really all across the board, macro growth, et cetera. So, it's very interesting to see this big turn. Of course, this is what happens in the media. And again, this is why we always warn you about paying attention to the media and listening to all this kind of, news talk that goes on, because again, a lot of these headlines are to get you to watch, to get views, right? So the more bearish they are, the more bombastic they are, etc., it tends to get views. But this is also why the media has the least amount of trust on record. Going back to the Nixon administration, where there was a very high level of trust in the media, there is now some of the lowest levels of trust in the media. Of course, when you don't really give people the truth, they tend to figure it out on their own. But this is why we tell you to really be careful about what you consume in terms of the media. Because again, a lot of these opinions and things are just that. First of all, they're just opinions. A lot of it's not based on factual information. And most importantly, they're designed to get you to give views, right? They want you to watch it. They want you to click on it. And particularly today, more than anything else, because, we have, everything is now a subscription, right? So in order to get subscribers, get people to actually pay for stuff, you've got to really get the information out there that's going to get people to click. You got to have the most bombastic headlines possible in order to get people to click that and then to subscribe for a month or two or whatever to read the articles. And this is just the world that we live in today. So just the point here is be extremely careful about what you consume, because that impacts your emotional state. And then that leads us to making decisions that typically don't work out for us long term. And again, a good example of that was in 2022. Everybody was like, get out of bonds. Bonds are terrible. And then they have a really good return year the next year. But that's what often happens. We've talked about this before. If you take a look at what's the best performer one year, it tends to be the worst performer the next year, because things rotate in the markets, things change. And as we look forward to this year, things are certainly going to change. Let's talk about earnings here real quick, because we're also about to start earnings season. But before that, let's talk about what you need to know before the bell this morning. So we are about to start earnings season next week. We're going to start getting earnings reports for quarter four. Now, quarter four earnings had the sharpest reduction in earnings estimates that we've seen in quite some time. There's a very, very sharp drop. Almost $8 a share in estimates was the decline in just the month of December. So a very, very sharp decline. And so that's lowered that bar a lot for companies to beat estimates. Interestingly enough, as we look at where the earnings are expected to come from, the vast majority of earnings growth is coming from the top 10 stocks in the index, basically technology. So, if you take a look at where the growth of earnings are going to come from, yes, we're expecting earnings to grow this year, but primarily dominated by the technology sector, also some out of healthcare, but mostly technology. So again, the markets here so far trading sideways, haven't gone anywhere. Now, yesterday we actually attempted to touch the recent highs in the market from December, rolled off of that right to the end of the day, but finished close to that level. We're looking to set up this morning a little bit to the upside. We're up about 4 points on the S&P. Again, everything's going to hinge right now on this CPI report this morning. If it comes in a lot hotter than expected, markets are going to sell off a bit, because, again, this is going to start to spark concerns about, well, maybe the Fed is going to have to kind of walk back some of their bullish statements. Maybe the Fed will have to remain higher for longer because we're seeing inflation tick back up. If inflation comes in line or lower than expected, markets are going to rally, potentially set a new high today. So, again, that's going to be really kind of the driver of the markets today, more than anything else, is going to be the CPI report this morning, and then what that potentially alludes to relative to what the Fed is going to be doing. And again, this is one of the problems of the markets that we have now, is that we no longer really operate on fundamentals. It's all about what's the Fed going to do. Is the Fed going to hike rates? Are they going to lower rates? Are they going to stay higher for longer? That's just the market we're in. We've got to deal with it for right now. But again, the markets here are doing absolutely fine. As we noted yesterday, we're staying right above the 20-day moving average. That 20-day moving average is on the rise. That's keeping stocks elevated. We're still in a bullish trend at this point. But again, there's certainly some risk here. We're still on a sell signal, still fairly elevated. So again, upside is probably somewhat limited at this point. But there's still the potential here for the markets to kind of gyrate here a bit more. That's what you need to know before the bell this morning. When we come back, like I said, I want to talk a little bit more with Mike about the Fed's outlook, particularly QE versus QT, and because this is going to be a big issue for the markets. There's certainly some things going on in the backgrounds. As we touched on last week, we're seeing reverse repo operations. We're seeing those overnight lending rates pop up here. There certainly seems that there might be some stresses within the financial system. Maybe that's an explanation for why the Federal Reserve is kind of backing off a bit here. We'll find out. I don't know, but the other big thing is going to be driving the markets here over the next few weeks, again, is going to be earnings. As we start, again, it doesn't matter that earnings estimates have declined. It's that typical end of the year, kind of earnings season. If we're going to beat estimates or not, that's going to be really driving stocks. Again, that's going to be one of the catalysts here, at least in the short term, to give stocks a bit of support, is going to be whether or not they can beat these estimates. But the important thing to be paying attention to is going to be their outlook. CEO confidence has been dropping sharply. We're starting to see impacts in the employment market. So the outlook is going to be the thing that we're looking for the most in terms of what our outlook for the rest of this year is going to be like. So quick break, we'll come back, we'll pick up with Michael Leibowitz. Lots of stuff to get into this morning, so hang around. Make sure you get by the website, realinvestmentadvice.com, and get your tickets for the upcoming event. Michael will be there to talk all about bonds and markets and more on January the 27th. Links on the website now.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So, some big news yesterday, and something I'll get Mike's comments on here before we get into the inflation piece, was that the SEC has basically now approved the Bitcoin ETFs. And there's like 12 ETFs that are all launching today. So, and this is always going to be interesting, right? Because these are spot Bitcoin ETFs. So it's actually going to price off the price of Bitcoin. So, it's going to be interesting to see how this works out. But again, so there's 12 ETFs that are coming out today. Invesco, BlackRock, all the usual names are coming to market with their, brand of ETF. And already, and these ETFs haven't even launched yet, and there's already a price war between how much to charge for these ETFs. So, it's going to be interesting to see, what the actual cost of these ETFs are, but they're all basically a quarter point or less. So they're very cheap right now to own. So if you want to own, Bitcoin, but not actually own the Bitcoin itself, you'll now be able to buy and trade an ETF. So, it does have some benefits from that if you're into the cryptocurrency thing. I did find this one statement from the SEC. This was actually in their announcement yesterday. So they issued the statement. And in the middle of the statement, as such, in contrast to previous proposals, based on the record before the commission is able to conclude that fraud or manipulation that impacts prices in spot Bitcoin markets will likely similarly impact CME Bitcoin future prices. So basically, you're buying an ETF that's subject to fraud and manipulation. Great. And I thought the SEC's job was to protect, when we established the SEC back in 1933, 1934, the whole purpose of establishing that was following the crash following 1929, because from 1920 to 1929, the banks were issuing IPOs for Wall Street and then loaning money to their clients to buy the IPOs. So there was this circular loop between the banks. So the banks would just issue more and more IPOs and then loan, and then basically tell all their clients, oh, you need to buy this IPO that we just issued, and we'll loan you money to do it. That was kind of the origination of margin. And of course, when it all blew up, we said, well, we can't have that happen anymore. We have to separate the banking and Wall Street. And so we established the Securities and Exchange Act in 1933 and then funded it with people in 1934. And the whole purpose of that was to protect investors from predatory practices. Now the SEC just says, hey, well, there's fraud manipulation, but hey, it's all on you. Go buy it. So anyway, you'll have lots to choose from today. Lots of Bitcoin ETFs launching at the open. Mike, what are your thoughts?
Can I throw in my 2 cents?
Yeah. You can throw your 2 Bitcoins in, sure.
So I thought most people everyone owns Bitcoin because they think it's going to go up. Let's just be honest. But a large number of people, the rationale is because they want something outside of the financial system. They want to own wealth that's protected from the financial system.
Yeah, not anymore.
Not anymore. Not anymore. Now it's like any other asset.
Yeah.
If you buy the ETF version. So it'll be interesting to see what percentage of like if we come back a year from now, what percentage of Bitcoin is owned by the ETFs versus owned by non-ETF players.
I'm glad you brought that up, because that was actually where I was going to go to here. Because so there is a finite amount of Bitcoin. And again, we're just talking about Bitcoin right now, okay? We're not talking about Ether. We're not talking about Doji or anything else, right? We're just talking about Bitcoin for the moment, because these are all Bitcoin ETFs. So that is the question. There's a finite amount of Bitcoin, and you got iShares, Van Eck, Franklin, Fidelity, Valkyrie, Wisdom Tree, Invesco, Bitwise, Grayscale, and ARK, all launching an ETF today. The question is how are they going to back this up? Because again, if there's only a finite amount of Bitcoin, then I've got to be able to buy that Bitcoin with the money that I have. And as I get new fund flows coming in, I have to buy more Bitcoin. So at some point, there runs the risk of there just not being a Bitcoin available, to buy. So it's going to be interesting to see how this gets worked out. Because they can't issue more Bitcoin, right? I mean, you can't just print Bitcoin.
Well, you manufacture, you mine them, right? So you create these massive algorithms that create Bitcoin.
Right. But hold on. Yes, you can mine it, but there is a finite amount of Bitcoin that you can mine, right? But, so at some point, you're going to mine all the Bitcoin there is to mine.
But I think with each Bitcoin that is mined, that algorithm becomes harder and harder and more expensive to create. So I wonder if by the time you get to that, 24 million? I forgot the number of Bitcoin that will ultimately be created, if it's almost impossible to create it.
Yeah.
So the cost of creating new Bitcoin just makes it that people stop mining it, and that the price of Bitcoin then fluctuates completely with supply and demand, and there's no new supply.
Well, that's exactly what's going to happen at some point. So the more that you pile into this...
I guess either way, right?
Right, so the more you pile into...
24 million, it's a finite.
Right. And they're not and these ETFs are not mining the ETF or mining the Bitcoin either, right? So there are companies out there that are strict miners, and you can invest in those companies that mine Bitcoin. ETFs aren't doing it; they're just buying off what's available in the market on an option basis. So I don't know how the inner workings of this is going to work. It's working off CME spot prices. But it's going to be interesting to see how that supply-demand imbalance works out. Right. I'm presuming these guys are smart enough; they've already figured this out. So it's beyond me, but we'll see.
are CME spot prices the same as Bitcoin spot prices?
It should be. It should reflect this is the whole point, right? The problem with Grayscale is that there's been a Bitcoin ETF out for a while, but it was not based off spot prices. So it didn't really track the price of Bitcoin, which was the frustration, right? So Bitcoin's going up and down in price, and there wasn't a good vehicle to track that increase or decrease in the price of Bitcoin. So the whole point of this was to get a product that would actually trade off the price of Bitcoin, right? Just like gold ETFs trade off the spot price of gold.
Right. So there's also MicroStrategy. That's a technology company. They're actually here in my backyard. They're in Virginia, and they own a ton of Bitcoin, and that's sort of their business plan. So the question is, why would anyone own that anymore either? You can just buy Bitcoin via an ETF.
Yeah, no, well, but again, their strategy is so MicroStrategy is a great example, right? They own a lot of Bitcoin that they're not going to release, right? They're going to hold that Bitcoin because that's their business plan. They've actually issued out debt to buy Bitcoin because their long-term belief is that Bitcoin's going to go to $100,000 in price. And this is one of those catalysts that may actually create that environment, right? And I was getting to this point, which is you're creating a lot of demand in a limited supply market, which is going to drive prices higher. So for MicroStrategy, this is actually great for them if they hold on to that limited supply of Bitcoin and you have a lot of demand for these ETFs. There's the potential that they're going to make a lot of money on this on the other side as Bitcoin rises because of this demand driven, brought in by these ETFs.
Right. That's a good point. And I guess, we should be looking at divergences between MicroStrategy's market cap and the value of their Bitcoin holdings.
Mm-hmm. Yeah. And
it's almost like a closed-end fund in a way.
Exactly. So, again, that was the other frustration. A lot of people were buying MicroStrategy as a good example. To get access to basically get access to Bitcoin without actually having to own Bitcoin, right? So, but it didn't track the price of Bitcoin, exactly. So it goes up with Bitcoin, but it doesn't track it, to the penny. So this is the hope of this, and it's going to be very interesting to see how this impacts both the trading in Bitcoin, but ultimately they resolve this supply-demand imbalance.
But you've also made Bitcoin a lot easier to trade, and you've also made it so you don't have to worry about security. And now you've brought in people that don't care about the value of Bitcoin as the financial aspects of it. They just care purely about the trading. So you've probably created a more volatile Bitcoin as well in the process.
Yeah, and this is the whole point of what we'll see, right? So, and again, once you launch ETFs, at some point, you're going to launch options on ETFs, launch options on these ETFs. So it's just going to add another layer of, volatility potentially to the market. It's going to be very fascinating to see, but, a big news yesterday on this. And again, I have no idea how this is going to eventually work out. I own some Bitcoin, so, we'll see, what happens, but, this is big news for the industry. So, again, we'll see how this all works out and plays out, but it's going to be really interesting to watch. And again, this is going to be, for a lot of people that want to own Bitcoin, but you didn't want to go set up a wallet and have to deal with, all the nuances of buying Bitcoin on, some off exchange. You'll now be able to buy an ETF and throw it in your Fidelity account. So.
Right. And money managers like us can now buy it without having to change anything in our systems, our custodial services. It just would flow right in like buying IBM or Apple. Yeah, it's going to provide, again, this is the whole point. It's going to provide a lot of demand for Bitcoin because it's now very easy to acquire it. So it's going to be interesting to watch. So like I said, I'm sure we're about to see all the laser eyes come back to the Twitter feed. So they disappeared temporarily. All the laser eyes are coming back. So, all right, quick break. We'll come back. Inflation out this morning. We're going to talk about that. We're also going to talk about the Fed's QT, QE, cutting rates, all that as we start to look forward into 2024. Don't go away. Life is an illusion. Can't you see that love is everywhere?
step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You've heard about this quiet quitting where, I'm just not being paid enough to do my job, so I'm just going to not really do my job. They now have a thing called the Bare Minimum Monday.
The Real Investment Show podcast.
Basically just doing the bare minimum on Mondays just to get your paycheck and go home. Ultimately, the people who run the business go, well, if you're going to do the bare minimum, I'm going to do the bare minimum and not need you anymore.
At realinvestmentadvice.com.
At some point, somebody's got to work. That's kind of the way it works.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back this morning. It's interesting. We were just talking before the break a little about the approval of these Bitcoin ETFs. I was just kind of glanced over here a second ago, and Bitcoin's trading up about 2% this morning. So again, it's around 47,000, still well below the 60,000 price that it previously traded at. And of course, we had that huge correction down towards 16,000. So it's been climbing its way back. It's been a good return here from those lows over the past few months. But you would kind of think, and I was a little bit surprised. I was just thinking a little bit surprised, with the approval of these Bitcoin ETFs, I would have expected Bitcoin to be up, 10, 15, 20% this morning. But again, maybe all this was already kind of priced in, kind of heading into this announcement. We'll see. But anyway, I digress. So a little bit about, this morning we've got CPI coming out. Big question is it going to show an uptick again? Is it going to go down lower? What is it? Lots of comparisons back to the 1970s when inflation came down and then it resurged again. And there was this big pickup in inflation. And, if there's a lot of individuals that are convinced that that's going to be the next leg here, right? So we're going to have this next big pickup in inflation. Right now, we really haven't seen that so far. Inflation's been kind of just moderating lower back towards, what the economy can generate, around 2%. The economy for the fourth quarter is expected to come in at about 2%. That's going to put us at about 2.5% for all of last year. So inflation should theoretically trade around that economic rate of growth. But, again, we're right now around 3% as of the last report. Question this morning is what will we see? And then more importantly, will this report, if anything, change anything about what the Fed's doing? And that's the big question here. So, Mike, what do you kind of think about inflation this morning?
Well, let's kind of remember where we've been recently, because the number is still 3% year over year, and that's a big number, right? Compared to what the 2% the Fed wants, much lower than where it's been, 8 or 9%. But the prior 2 months, it was 0.1%, and the month before that, 0.5%. So they're expecting 0.2% today. So if we just look at the localized inflation, what's inflation been running if we annualize it now? It's somewhere between 1 and 1.5% inflation, right? Inflation has largely been slayed for the time being, right? Who knows what the future holds? But the kind of the more short-term rate of inflation is where the Fed wants it to be, if not maybe even a little lower. If you go back a year ago, we were looking at 0.5% or so inflation a month, which gets you to roughly 6% a year. So once we start, assuming we continue at 0.2%, 0.3, 0.1, we're going to be back to 2% once we get some of those old numbers out of the annual calculations. But again, what we care about is the trend, not where it was a year ago. So, we're going to look at today's numbers and see what they did, recognize that we're now entering seasonal aspects that like all data in, December and even back in November, the data gets a little squirrely because our consumption habits change, businesses operate a little differently. Obviously, the holidays have a big impact on things, but the expectation is 0.2%. That's what, 2.4% inflation if you annualize that. And again, much less if you look at the rolling 3 months. But again, Lance, I think the biggest factor is going to be housing costs. Roughly 40% of the number is rents and imputed rents based on house prices. And the BLS data or the BLS calculations greatly lag what's happened in the economy. So there's still the BLS data is still due for a big drop off in house and rent prices. Rent prices have been running flat. House prices have been upticking lately a little bit, but the data that BLS is using is still much higher housing inflation than what we've seen for the last 6 months or so. So the wild card is what happens with shelter prices.
And again, and this is kind of the interesting thing is that housing prices are expected to increase about 3% this year. And it will likely be more than that if the Fed does start cutting rates, right? So if we do see the Fed cut rates, that's going to drag down the longer end of the yield curve. And that's going to push, shelter cost up even more. I guess that, the one, kind of interesting point is that we have a record amount of multifamily apartments being built and rents have been under pressure. So if we take a look, again, we're not talking about just home prices when we talk about homeowners equivalent rent. It kind of factors in a lot of different things. But, you are seeing rents coming down because of this massive oversupply of multifamily properties. And I think there's going to be a real opportunity, probably in the not far too distant future for somebody looking to get into the multifamily apartment business because you'll be able to buy stuff really, really cheap. But, we're not there yet. But again, there is going to be this kind of interesting knockoff between the decline in rents because of an oversupply of multifamily properties and the increase in home prices due to declining mortgage rates. If the Fed cuts rates, right?
And what's kind of silly when you put it in that perspective, the Fed is running monetary policy based on inflation data that is, significantly on housing. And yes, interest rates greatly affect housing, but there's so many other factors, demographic and others. So, it helps explain why the Fed is not great at managing inflation, because a lot of it is out of their hands. Right. There's a house, right? Like you said, this boom in construction for residential properties is crazy. And at the same time, office space, they can't give it away anymore. There is so much vacant property in office properties. Buildings are selling. In a commentary from, I think, a day or two ago, we showed a piece that's literally a block around the corner from me that sold for $130 million in 2018. It just sold for $30 million.
Right.
In a coveted area on top of a subway station. So, it's weird to look at this economy and see that they can't build enough apartment buildings, condos, and at the same time they have all these other buildings that are just sitting vacant. And the Fed is trying to steer policy based around the inflation that comes off of those residential properties.
Right, and again, and I guess what my point is that the Fed's actions can act against them in terms of bringing down inflation. Oh, we think inflation's under control. We're at 3. We think we're heading towards 2. And then they cut rates, which boost, the very thing that drives over 30, well over 35% of the CPI index, which is housing prices. So all of a sudden you start boosting housing prices again because you cut mortgage rates. And there's a lot of pent up demand right now that people want to buy a house. They just don't want to pay a 7% mortgage, or they can't afford the monthly payment at 7%, but they can afford the monthly payment at 4%. So all of a sudden you start bringing mortgage rates down, housing prices go up, you start getting another influx of inflation and the biggest component of the CPI index, which the other factors may not be able to offset.
And this gets back to what we've been talking about. What is the Fed doing?
Right.
What are they thinking? Right. They studied the 70s so much. And if you look at the 70s, you know that there were waves of inflation. And a lot of it is due to Fed error. A lot of it was due to the mistakes the Fed made. So if you're the Fed right now, I get why you want to lower rates, but just slow your pace down. The last thing you need is for inflation to peak back up again and scare the economy, scare the banks, most importantly, scare the bond markets. Yeah. Because if you get another run in yields back up above where we were or even higher, the risk of a crisis, which is probably still existing, especially for the banks, increases substantially.
Well, and it's an interesting point that you make about the 70s because, there wasn't just one spike in inflation. We all remember the late 70s. And actually, we talk about the 70s, right? But actually, we had inflation running in bouts from the 1960s and into the 1970s. It was just that last spike during the oil embargo that we all remember. But to your point, we had this continual kind of trending a rise in inflation that was going along with significantly stronger economic growth because we were doing a lot of manufacturing back then. But to your point, the Fed would hike rates, inflation would come down, then they would start cutting rates, and inflation would go back up again. And then so they would hike rates, and then once inflation started to come down, they would cut rates, and inflation would go back up again. And so it seems, to your point, that they might actually be walking to exactly that same trap. Oh, I think inflation's coming down. We cut rates. We spark another, push within the economy of increasing demand. I mean, we're already going to see an increase in economic activity because of the loosening of financial conditions, lower yields, higher stock prices, boost consumer confidence. People go out and they buy stuff. You're going to get. This is why you're getting, 4.9% GDP growth in the third quarter, 2% growth in the fourth quarter. We continue to see, activity continuing, despite the fact we all keep expecting a recession to occur, and it just doesn't occur. And we have all this money in the system. So, the Fed's very much, potentially putting themselves up to be in that same position where they cut rates and they spark a lot of demand within the economy, rising asset prices. All of a sudden, they got inflation coming back. When we come back from the break, we'll pick up with Michael Leibowitz, talk about QT, because now the Fed's even talking about stopping QT starting in May. Talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Quick administrative message here. Monday and Tuesday, we are not sure that we're going to be able to broadcast a show depending on this freeze that's coming in. If it's a dry freeze, just cold weather, there's no problem. But if it turns out to be a wet, icy one, we're probably not going to be able to get into the studio. And plus, the building that we're in, that our studio is in, has a propensity to lose power during ice storms. So we may be here. If not, we will have some content for you regardless on Monday and Tuesday. But just be aware that we don't know what this is going to be like come Monday and Tuesday. But we'll certainly be updating our blogs and updating our daily commentary and answering questions on our website. So if for any reason we can't get in here to do a show and you've got a question, just get by the website, email us. Always happy to help you. Okay, so having said that, we'll see what happens. So just talking a little bit before the break about the Fed, talking about rate cuts this year, but yet we still have this potential risk of inflation. And at the same time, they're now talking about cutting rates. it's now becoming a much broader expectation by the markets that the Fed is not only going to cut rates this year, but they will start reversing quantitative tightening starting in May. So, what we've seen over the last year or so is the Fed allowing their balance sheet to roll off. So they haven't been actively selling bonds in the markets. They just have been letting bonds mature, and they just weren't replacing them, and that's been reducing the balance sheet. But that's even now expected to come to an end starting in May. So in May, they'll start tapering their rate of QE back towards zero. And it's even expected that by the third or fourth quarter of this year, potentially as early as the third quarter, that the Fed will start quantitative easing again. In other words, buying bonds to put bonds back on their balance sheet. And of course, as we've done the analysis before, there's a very high correlation between quantitative easing and market outcomes. Just saying. So, but Mike, it's kind of an interesting thing. If we take a look around, the markets are doing fine. We had a 15% rate of return the last 2 months of the year. So nothing wrong with the markets right now. The economy's doing okay. Sure, employment is starting to show some signs of weakness, but nothing extreme. Unemployment claims remain very low, historically low. But yet we now have the Fed kind of going into seems to be what's more akin to crisis management, what we've seen in the past, of them taking actions that are normally associated with something breaking in the financial markets, but yet there seems to be nothing really wrong here. So, is the Fed making a mistake?
I don't know, but I think what concerns them is the Fed's repo program. So the Fed basically has a program where they take money in, excess liquidity from the markets, from the banks, from money market funds, from a bunch of other institutional investors. And that reverse repo program got as high as, I think, like 2.4 trillion at one point. It's now been steadily declining. It sits around 500 or 600 billion. It'll be gone at this rate by March, give or take a little. What that repo program represents is excess liquidity. Once that program is gone, in the Fed's mind, most likely, they think that liquidity is back to normal. Every day after that, liquidity is actually sub what they think it should be. So that's why I think that they are starting to talk about reducing tapering QT. I think we're way too early for QE. But I think they realized that maybe what happened, we've talked about what happened in 2019, that there was a liquidity problem. Maybe what they're thinking is that liquidity problem is finally resurfacing 4 years later, that it was kind of put on hold because of actions the Fed took in 2019, and especially the actions they took for COVID, for the pandemic. So their concern may be a replay of what was beginning to play out in 2019, and that would help explain why they would want to stop QT and potentially at some point do QE. It would also explain why they want to lower interest rates, despite inflation coming down significantly, but not being fully back at their level. So it's really hard to fathom what the Fed is thinking right now. Through 2022, Powell harkened back to the 1970s nonstop. They clearly did their homework on the 70s. They saw all the mistakes the Fed made, all the mistakes the government made, the behaviors of human beings and how they react to inflation. And Jerome Powell was constantly quoting things like price wage spiral. They don't want inflation to get into the mindset of people because then their consumption behaviors change. And clearly that they recognize that the risk of reigniting inflation with bonehead policies is a real possibility. So, it's hard to fathom if they really think that a potential liquidity risk is a huge problem, big enough to offset the potential for another round of inflation. It's a really interesting dichotomy of potential problems right here.
Yeah, and again, when you take a look at, and again, there's a lot of, arguments for both sides, right? You take a look at leading economic indicators, they're negative. Take a look at ISM manufacturing, it's recessionary. You take a look at yield curve inversions, clearly recessionary. We've got a lot of indicators that suggest that a recession's coming, yet you take a look at the actual economic data itself, and there's really no sign of that at the moment. It's, if I'm the Fed, I'm looking at this kind of conflicting set of data, and I'm making a bet almost that, there's a, and again, you have to, this is just from the 30,000 foot view, is that, there's something wrong within the overall economy that, I've got to start backing off this tighter policy. Otherwise, I'm going to create a hard landing within the economy. So that's what the view looks like. But, to your point with reverse repo and kind of what's going on there, does the Fed see something that's more immediate that's happening within the kind of the underbelly of the financial system that is more worrisome than just kind of broad macroeconomic data? Because again, you take a look at CPI or employment, there's no reason to rush into doing anything, but it feels like the Fed's taking a more aggressive push as if there's something actually fragile within the system.
Right, and they've completely gone back on what they said back from October and November. They said that higher interest rates, lower stock prices, were tightening financial standards. That was great because it was doing their job for them. That's completely not the case anymore. Financial conditions have eased at a quicker pace than any other time in history over the last couple months. And the Fed is not saying anything about that. They're not reversing their stance. And even the most hawkish of the Fed members is becoming dovish. No one expects a rate hike anymore. Rate hike was, the market was pricing in, anywhere from 20 to 40% chance of a rate hike throughout most of the last quarter. And now there's almost 0% chance of a rate hike. And the only question in the market's mind is, will the Fed cut as early as March?
Right.
And you just don't see, on the economy, you just don't see it, right? You can point to the employment numbers, and there were some concerning parts of it. But at the end of the day, I think this is a financial markets, a credit, a liquidity issue that's brewing, and that's being brought to the Fed's attention, and that they are concerned it gets potentially out of control.
And again, it just, Mike, I've talked about this before, but this reminds me so much of 2018, where in September of 2018, the Fed's hiking rates were nowhere near the neutral rate. By December, they hadn't hiked rates anymore, but they completely reversed their stance. Oh, we're at the neutral rate. Everything's fine. Market starts taking off. In July, they start cutting rates. In September, they're engaged in reverse repo to bail out, Citadel and hedge funds, which we didn't know until later on into the year. But, it seems a lot like that same type of setup is occurring, and they see that same evidence, and now they're even acting quicker than they did back in 2018, 2019. Like, they're moving more quickly to resolve whatever's happening in the reverse repo market more quickly than they did back in 2019.
Right. And just to be clear, the Fed wasn't really trying to protect the hedge funds. They were protecting the banks that have exposure to those hedge funds.
Yes, I should. Yes. That's a good clarification.
Just to be clear, the Fed Act says the Fed only has a couple of objectives, and that's maximum employment and price stability, right? They actually have a third objective, and that's to keep the banks in business.
Can we clarify?
Make them profitable.
Right, but can we clarify that third objective a little bit more, which is to protect their member banks against financial distress?
And I would actually clarify it even more. They have one objective, to protect their member banks. If they can get inflation down and employment to its maximum levels, that's great. But goal number one comes before 2 and 3.
Exactly right. So as we get ready to kind of wrap up the show today, be sure and get by the website, realinvestmentadvice.com. Buy your ticket. Michael Leibowitz will be here live on January the 27th, 8 a.m. to noon. We're going to be doing some presentations on the bond market, on the election, the stock market outlook for the year. Adam Taggart will be here. Greg Valliere will be here as well to talk about presidential election cycles. We're going to have a little mixer after the fact, so we'll be able to shake hands and answer any questions you have directly. So get your ticket now online at realinvestmentadvice.com. Just click the banner at the top of the page, get your ticket, and we will love to see you. January the 27th at Hotel Sonesta in Houston, Texas. And we'll be back tomorrow with Financial Fitness Friday with Daniel Ratliff and Richard Rosso. See you then.